Welcome in this video. Can Zbcn coin be 10 cents? We will analyze this. Don't forget to subscribe, like, and please watch to the end to understand.
First of all, when looking at the chart, one of the most prominent structures that stands out is the descending trend line. A descending trend shows that the price has been making lower highs with each attempt over a certain period, indicating a downward movement. In other words, it shows that the market is generally under selling pressure, that buyers are struggling to push the price higher, and that sellers continuously enter the market at lower levels to establish dominance. Such a trend line usually makes it harder for the price to move upward, because each time investor psychology shapes around the idea that this level is a selling zone, and it acts as resistance. However, from a technical analysis perspective, the most critical moment is when the price is able to move above this descending trend line. Because once the price moves above this line, it signals that the influence of sellers has weakened, buyers have gained strength in the market, and the probability of the trend reversing has increased. Breaking above the descending trend should not only be confirmed by a few candles, but also by a strong close. Especially on daily and weekly charts, such closes provide much more confidence for market participants. This is because intraday breakouts can sometimes be misleading. Large investors generally make decisions based on closing prices. If the price breaks this trend line with strong volume and closes above it, this could indicate the start of a new upward wave in the market. That's why the phrase trend breakout is critical for technical analysts. Breaking a descending trend also creates a major shift in investor psychology. Investors who have seen the price remain lower for a long time now notice that new buyers are eagerly opening positions above this line. This refreshes confidence in the market because the determined return of buyers strengthens the possibility of the trend reversing. At this point, the breakout is valuable not only technically, but also psychologically. When the majority of investors begin to think the decline is over, the rise is starting, this expectation is reflected in the prices, and a new upward trend begins to show itself. When the price moves above this line, it is often interpreted as a signal of a trend reversal. This is especially significant in long-term descending trends because it shows that months or even years of pressure have ended. In such cases, the rise is not limited to a short-term reaction move, but carries the potential to turn into a longer-term rally. Therefore, once the trend line is crossed, it is generally expected that large funds, institutional investors, or high-volume players will enter the market. These inflows accelerate the price momentum and begin a more sustained upward move. In addition, technical analysts use some supplementary indicators to confirm the breakout. For example, increasing volume shows that the breakout is not fake and that strong buyers are getting involved. A volume-supported breakout makes the possibility of a trend reversal stronger. Also, if the price, after breaking out, retests the trend line and finds support there before continuing, this is a very valuable sign. This is the classic breakout retest scenario. In other words, the price first surpasses the descending trend, then briefly pulls back to test that line, and then rises again. This strongly confirms that the trend has truly changed. With a move above the descending trend, investors also pay attention to target levels. The price often starts to move toward previous highs, because this allows the price to move toward higher resistance levels. Especially after the descending trend is broken, initially there is a move toward the nearest resistance levels. As these levels are surpassed, investor confidence grows even further, opening the way for larger rallies. Psychologically, breaking a descending trend is also a very important threshold. Investors who have seen the market with a bearish outlook for a long time now begin to seize buying opportunities. Investors who can no longer withstand the selling pressure and exit at a loss are replaced by new buyers. Thus, the dynamics of the market change completely. While the power of sellers is broken, buyers gain strength, and in such an environment, the rise in price can be much stronger. Therefore, trend breakouts are turning points not only technically, but also in terms of market psychology. In this process, fundamental developments can also play a supporting role alongside technical analysis. If, during the period when the price breaks the descending trend, there are positive news flows, data supporting the rise, or strong expectations in the market, the impact of this breakout becomes even greater. In other words, moving above the trend is not just a graphical phenomenon, but also an indication that the overall perception in the market has changed. Therefore, when technical and fundamental factors come together, the breakout can produce much stronger results. To sum up, when the price moves above such a descending trend, it shows that the pressure in the market has ended. Sellers have lost their strength, and buyers have regained control. This may not only be a short-term move, but also the beginning of a long-term trend change. That's why it's one of the most important developments investors should closely monitor. When the price moves above this line, a whole new upward story begins on the charts. This story often brings with it a process that changes not only price movements, but also the psychology, strategies, and market perspectives of investors. But we can't make decisions based only on trends. Let's take a look at the other metrics as well. Stay tuned.
In technical analysis of price movements, the concept of a bullish order block represents an extremely critical structure for investors. A bullish order block generally refers to the last bearish candles or the consolidation zone right before the price begins a sharp upward move. This area is essentially where big players, meaning institutional investors and those with strong capital, place large buy orders, acting like a hidden field of force that is invisible in the market but deeply influences price action. Prices often find support in these regions and tend to start another upward move from there. The main reason for this is that a significant amount of buying demand had previously accumulated in that zone, and when the price trades there again, the likelihood of buyers stepping back in increases. For this reason, bullish order blocks hold a strategic position for both short-term traders and medium to long-term investors. When the price pulls back toward a bullish order block, it may often seem like a cause for panic among investors, but technically, this situation can actually be a signal for a new bullish opportunity. This is because when the price returns to the same area that previously triggered a strong upward surge, it can lead to buyers re-entering the market. The psychology here is very important. Many traders feel like they missed the train when the price is rising and wait for a pullback. The bullish order block becomes exactly the point where these pullbacks pause. When the price reaches this level, with buyers aggressively stepping back into the market, upward bounces are observed. These bounces often gain strong momentum and quickly push the price toward testing significant resistance levels. However, the technical importance of a bullish order block is tied not only to psychology but also to liquidity structure. Large capital investors, the so-called whales of the market, usually do not open their positions in a single move. Instead, they wait for the price to pull back to certain areas and make staggered purchases when liquidity builds up. The places where these staggered purchases occur most intensely are bullish order blocks. For this reason, when the price reaches these zones, it creates an effect as if it were pushed upward by an invisible hand. As long as the price does not drop below such a zone, the likelihood of the bullish trend continuing remains high. The price reaching a bullish order block and bouncing upward from it is also a sign that the trend structure is progressing healthily. In bullish trends, the price never moves in a straight line. It rises in waves. The troughs of these waves often align with bullish order blocks. In other words, these regions are where the trend catches its breath, regains strength, and gathers energy for a new rally. As long as the price finds support from these levels, confidence in the continuation of the trend increases. This confidence boosts the buying appetite of both individual and institutional investors, further strengthening the upward movement. Additionally, the areas where bullish order blocks form may overlap with Fibonacci levels, previous support resistance points, or moving averages. In such cases, the strength of these zones multiplies. This is because when different technical analysis tools point to the same level, it increases investors' confidence in that area. When the price bounces off these regions and turns upward, not only does technical analysis come into play, but market psychology also activates at the same time, and buyers start entering one after another. This opens the door to strong and sustainable upward moves. Another critical importance of a bullish order block is the opportunity it offers for risk management. When investors see these zones as potential buying points, they usually place stop-loss orders just below the block. In this way, they minimize their risk. Because if the price falls below this zone, it signals that there has been a breakdown in market structure and that the bullish expectation is no longer valid. However, if the price finds support and turns upward from this area, potential gains can be much greater while risk remains relatively low. This offers an extremely attractive risk-to-reward scenario for investors. Furthermore, the fact that bounces following price movements into bullish order blocks often turn into strong rallies reinforces the reliability of this structure.
An ascending channel formation is one of the most frequently used structures in technical analysis and serves as one of the most important tools for tracking the general direction of price. This type of structure shows that both the lows and the highs of the price are moving upward in parallel. The lower band of the channel acts as a support line, while the upper band serves as a resistance line. The price moves within this channel, fluctuating as it goes, finding support each time it hits the lower band when buyers step in, and facing resistance each time it reaches the upper band due to selling pressure. For this reason, an ascending channel essentially shows that the price is advancing upward in a healthy step-by-step manner. If the price manages to reach the upper band of this channel, a stronger bullish potential appears in the eyes of investors. This is because the potential for the price to break the channel upward creates expectations that the uptrend may accelerate. Here, the 10-cent level stands out as an important target, since when the price reaches the upper band, it will naturally have touched this region, and investors will view this level as a key milestone in the short term. The price moving within an ascending channel also indicates that the market is progressing in a balanced and healthy manner. In other words, the price doesn't make a one-way aggressive move up or down. Instead, it advances upward rhythmically as a result of the balanced struggle between buyers and sellers. In this progression, strong buying comes in each time the lower band is tested, lifting the price, while profit-taking or short-term selling emerges each time the upper band is tested. However, the point to pay attention to is that with each new test, buyers become more confident while sellers grow more cautious, causing the price to put increasing pressure on the upper band. This actually shows the continuity of the uptrend and the strengthening of upward momentum. If, when the price reaches the upper band, a strong breakout occurs with high volume, it can be said that the 10-cent level is not just an intermediate target, but could become a powerful level that opens the door to a much larger rally. One of the most striking aspects of ascending channels is how clearly they reflect investor psychology. Because the movement of price from the lower to the upper band throughout the channel shows that investors view every dip as a buying opportunity and have confidence in the market. This atmosphere of confidence is one of the key factors that allows the trend to continue. In addition, in the eyes of investors, the channel's upper band is seen as a kind of target or level to be reached. Therefore, when the price reaches 10 cents, more interest and excitement may emerge in the market. This excitement may cause more buyers to enter the market, potentially pushing the price beyond the upper band. However, sometimes when the price reaches the upper band, it may experience a period of consolidation, which should be interpreted as a natural breathing phase in the market. Still, by its very nature, since the general trend remains upward in an ascending channel, the bullish potential remains strong even after the price reaches 10 cents. From a technical standpoint, the lower band of the ascending channel serves as a trend line and acts as a support area that the price consistently stays above. This gives investors confidence as the price finds support from the same trend line on each pullback. The upper band of the channel is the strongest resistance area the price encounters. If the price tests this band with strong volume, an upward breakout may occur. In such a scenario, while 10 cents becomes the first target, the potential for an additional rise equal to the height of the channel also emerges. This excites investors because a breakout above an ascending channel usually signals that the trend will accelerate. Therefore, when the price reaches the upper band, not only the 10-cent target but also expectations for higher levels may form. Another important aspect of the ascending channel is that it reflects strong trend awareness in the market. The longer the price remains within the channel, the stronger and more solid the trend is considered to be. This allows investors to move with confidence. In other words, if the price reaches the upper band and rises to 10 cents, this is perceived not only as a technical target, but also as a strong indication of the trend's strength in the market. Even if investors take short-term profits in such a situation, since they know the general trend will continue upward, they tend to hold their positions or buy again, which in turn supports the continuation of the price's rise. Looking at the psychological side of the market, the price moving towards 10 cents creates a significant shift in investors' emotions. These levels are often psychologically important round numbers and form a kind of threshold in investors' minds. If the price reaches and holds at this level, investor confidence increases further, leading to the entry of new buyers into the market. In this way, a powerful combination of technical and psychological factors emerges. In other words, the move towards 10 cents is not just a technical channel movement, but also shows that market psychology is strongly shaping in a positive direction. The price reaching the upper band within the ascending channel is also important in terms of volume analysis. If this move is supported by strong volume, it indicates the market's determination and that buyers are in control. In other words, if the price reaches 10 cents and is simultaneously supported by increasing trading volumes, this is not just a coincidence, but can be interpreted as a strong continuation signal of the trend. Since volume is one of the most important confirmation elements in technical analysis, the move towards 10 cents being supported by volume brings with it an even stronger rally potential. From a long-term perspective, the ascending channel shows that the price is rising in a healthy manner and indicates that the trend is sustainable. The price reaching 10 cents can be seen as a short-term target, but beyond that, investors should also take into account that the trend has not broken and that the price may move to higher levels. In other words, the 10-cent level may just be a stop, the beginning of a larger journey. Because when ascending channels break, the price generally moves in that direction. If the breakout is upward, levels beyond 10 cents may come into play.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.